Disclaimer: Reggie and Royal's analysis and insights are based upon data gathered by it from various sources believed to be reliable, complete and accurate. However, no guarantee is made by Reggie and Royal, or Vision Associates LLC as to the reliability, completeness and accuracy of the information so analyzed. Reggie and Royal is in the business of gathering information, analyzing it and disseminating the analysis for informational and educational purposes only. Reggie and Royal attempts to analyze trends, not make recommendations. All statements and expressions are the opinion of Reggie and Royal and are not meant to be investment advice or solicitation or recommendation to establish market positions. Our opinions are subject to change without notice. Reggie and Royal strongly advises readers to conduct thorough research relevant to decisions and verify facts from various independent sources. Copyright 2021 Vision Associates LLC. All rights reserved.
Welcome back to the Reggie and Royal podcast. As we left episode 2, Bitcoin and Beyond, we saw Michael Saylor answer his question, "What is a dolphin fin dog doing up in a tree?" He asked this question at the North American Bitcoin Conference in early June, as he gave us his 3 components of the crypto universe, or the crypto ecosystem. He sees Ethereum as the core cryptocurrency for this aspect. Go to episode 2 for a full view of Saylor's crypto universe. Quite a few others in the financial arena haven't been as committed to cryptocurrency as have Michael Saylor. To typify, when we hear the phrase never say never, we refer to hearing that a person should not say that he or she will never do something, because people change their minds. This podcast will begin to cover a sampling of over a dozen of the biggest names in finance, who have gone from total skeptics, or total condemnation, into totally committed, and significantly invested, to the cryptocurrency spaces. This should put any remaining skepticism by lesser-known players completely to rest. Until lately, cryptocurrencies appeared to be far from the type of institutionally sound investments that would certainly be attractive to CFOs looking to branch out a company portfolio. Once seen as gimmicks for unsophisticated retail investors, a lot of whom bought cryptocurrencies based upon odd internet classifications, ridiculous youngsters' songs, or perhaps remarkable hip-hop musicians, few would certainly expect the notoriously volatile electronic currencies to trace a path right into business treasuries. The jokes are now over, or possibly, are just starting to grow old. As execs have stashed corporate cash right into digital money, these new novelty properties are currently a growing choice to contribute to company ledgers. With this development right into this underdiscovered area, nonetheless, comes extra risks, from both personal litigation, as well as analysis from authorities. Similarly, as with any kind of unique property, CFOs should balance their need to invest creatively, with the worries of wary investors. On these fronts, cryptocurrencies project risks for those charged with charting their businesses, and navigating through contemporary legal, as well as regulatory shoals. Bitcoin advantages. Commercial investments so far generally have remained in what has passed for recognized cryptocurrencies, mostly Bitcoin, that have belonged to the universe of money for several years. Charged mainly with cash money and liquidity monitoring, corporate treasurers generally purchase low-yield, low-risk properties like money market funds, national debt, or commercial paper. What could motivate a well-established firm to reallocate its useful possessions right into a currency that can rise and fall based on web message boards? The major solution is easy: inflation. For several, Bitcoin, and also various other well-established cryptocurrencies, are a sort of electronic gold, an asset that needs to, in theory, hold its purchasing power, when various other possessions, ergo, currencies subject to monetary plan could not. As financial experts have actually described in relation to Bitcoin, due to the fact that there is no reserve bank associated with regulating its cost, and also the supply is gauged, the cryptocurrency could work as a barrier against inflation, caused by reserve bank monetary policy. Currently, with monetary stimulation flooding markets, complying with the COVID-19 pandemic, inflationary concerns have made cryptocurrencies, with monitored supply, extra attractive to specific companies. Leading the way are business and executives, accredited for their forward thinking, as well as occasionally brash, business methods. At the forefront of this trend is MicroStrategy Incorporated, a software application firm that flaunts that it has actually been placing billions of business assets right into Bitcoin, and also now declares that the majority of its corporate treasury is in the cryptocurrency. Square, a financial technology firm headed by Twitter CEO Jack Dorsey, likewise has a more than $200 million business stake in Bitcoin. However, in the area of disruptive monetary innovation, Elon Musk is the undisputed center of mass. Indeed, some guess that his public declarations about the cryptocurrency markets have actually reallocated the cost of the property all by themselves. Musk has gone to the vanguard of the business change to cryptocurrency financial investments, and has been a public supporter of its possession. In a February 2021 SEC document, Musk's electrical automotive firm, Tesla, revealed that it had acquired $1.5 billion in Bitcoin. Ever since, Musk has actually been timid about the business's digital holdings, but overall has actually been one of the most noticeable company execs to recommend that electronic currencies are the wave of the future for innovative multinationals. Musk has actually also recommended that Bitcoin may be a feasible option for retail purchases. In March 2021, Musk indicated that Tesla customers would certainly be able to acquire its electrical vehicles by making use of Bitcoin. Practically instantly, doubters explained the ecological prices of Bitcoin removal called mining, and said that the environmental effects of increased cryptocurrency use were in conflict with Tesla's eco-friendly picture. Musk was required to reverse course on the approval of Bitcoin for consumer purchases, though the business affirmed that it would keep its own investment in the electronic asset. Musk's advocacy has actually not been limited to Bitcoin. Nevertheless, he has lately said that he would not sell another cryptocurrency, Dogecoin, as well as even going as far as to claim that SpaceX, Musk's industrial rocket business, would make a Doge-funded journey to the moon. It continues to be seen, nevertheless, just how much of Musk's participation in cryptocurrencies is significant or tongue-in-cheek, as well as his discussing the subject having come just before wild changes in price. As one could expect from a unique asset originating from a checkered past, cryptocurrencies bring distinct legal and regulative risks. Company managers should firstly take into consideration whether spending business funds in cryptocurrencies influences their fiduciary tasks to investors. Cryptocurrencies are not without critics, a few of whom surely hold supply in businesses that have actually been, or are taking into consideration making use of assets to buy cryptocurrencies. Although shareholder matches based on cryptocurrency procurement have yet to make their method to the courts in purposeful numbers, as more businesses pack corporate coffers with Bitcoin, and also other digital currencies, more litigation might follow from disappointed owners of crypto supplies. One of the most uncomplicated lawsuit risks is that in spite of the academic assurance of cryptocurrencies, as somewhat familiar, and intervention-resistant properties, cryptocurrencies are unpredictable. As demonstrated by the current as well as seemingly arbitrary swings in cryptocurrency markets, with costs fluctuating hugely in current weeks, cryptocurrencies can be very uncertain. This unpredictability is not limited to novel or exotic electronic properties. Bitcoin lately plunged almost 30% in a solitary day, triggered partly by China's crackdown on cryptocurrency transactions. Recent market volatility in Bitcoin's cost has led some to doubt whether the cryptocurrency can serve as a barrier against climbing inflation. Moreover, as federal governments move to closely regulate the purchase, and also sale of electronic assets, the possibilities for a disastrous loss for those with huge risks in electronic possessions are bound to rise. Should such losses hit corporate treasuries, CFOs, and also other managers may face cases that they mishandled business possessions. Volatility aside, cryptocurrencies raise an even more fundamental concern: storage. Normally, a cryptocurrency is kept in an electronic device, known as a wallet, to which the proprietor is given a personal accessibility code. If the owner loses this code, there is commonly no sensible way to access the electronic properties of the wallet, a fact which has led some cryptocurrency owners to be permanently shut out of their electronic treasure chests. Human error is not the only storage concern. In rare cases, cryptocurrency wallets can also fall victim to hacking. Companies that take big public stakes in cryptocurrency might consequently come to be prime targets for electronic burglary. Either loss could result in investor lawsuits for mismanagement of business properties, if the firm fell short in taking ample protective measures to safeguard its cryptocurrency financial investment. As Musk's about-face on Tesla's acceptance of Bitcoin payments programs, cryptocurrency's ecological impact might affect their stability as a corporate asset. According to one evaluation, around the world Bitcoin mining alone makes up the same power consumption as the country of Sweden. With investors increasingly conscious of their business's environmental effects, and protective shareholder campaigns to compel corporations to be faithful stewards of the setting, corporations that spend greatly in cryptocurrencies will certainly face mounting pressure to account for that financial investment in their disclosures of climate effects. Entities that are not transparent might deal with investor legal actions, alleging that they were holding back regarding the ecological dangers of their financial investments, or, on which such omissions triggered the value of the company to drop. Firms also need to make sure that any investments in cryptocurrencies follow previous company declarations, lest shareholders bring cases that the previous declarations were illegal or deceptive. Capitalists have actually utilized companies' common declarations regarding a business's ecological, social, and also governance (ESG) plans, in various other problem locations, as the basis of a class action where the firm's conduct was irregular, with its aspirational declarations. Hence, a company's common declarations concerning its dedication to sustainability may be deemed deceptive, if it nevertheless buys resource-consuming electronic possessions. CFOs must, as a result, beware that corporate investments in cryptocurrencies do not contradict their prior public statements, in a manner that could be deemed misleading, lest they subject the business to litigation. Other functions of cryptocurrencies also can create lawsuits. For beginners, electronic tokens still feed on the relative edges of the economic world. The mostly confidential nature of most crypto purchases has actually made them the money option for crooks of all shapes and sizes. Also, businesses taking part in legitimate deals are trusting their funds in assets whose performance history and online reputation are still to be proven. Without a doubt, the decentralized, as well as uncontrolled nature of cryptocurrencies, principal marketing points for some capitalists, likewise indicates that corporate managers are left without significant support on the legal ramifications of their financial investments. For example, no cryptocurrency-specific advice exists for firms regarding how they ought to make up cryptocurrency holdings on their company journals. The Financial Accounting Standards Board, which establishes accountancy requirements for U.S. corporations, has yet to state policies for cryptocurrencies specifically. The U.S. Generally Accepted Accounting Concepts, GAAP, likewise are silent on the treatment of electronic assets. So far, this has led businesses to use the accounting concepts established for abstract assets, comparable to a good corporate reputation, or brand name recognition. Notably, this implies that the firms cannot instinctively protect gains in value if the rate of the possession increases, yet should track their investment if the asset falls. Thus, for accountancy functions, companies might find trouble establishing an ROI for cryptocurrency. A business might have the ability to discuss how it takes into consideration the worth of its electronic properties to capitalists, with added disclosures. However, the continuous, as well as decentralized trading of electronic currencies like Bitcoin on several exchanges, suggests that capitalists will just receive an estimate of a possession's value that could be outdated almost as quickly as it is issued. A similar problem is that public firms subject to auditing demands might have problems showing that they have custodianship over decentralized digital possessions. Inasmuch as shareholders are disappointed with digital financial investments, corporations currently have little capacity to show that their choices, to invest business funds in cryptocurrencies, are adequately justified. The absence of pertinent accounting requirements additionally makes complex firms' public disclosure needs to the U.S. Securities Exchange Commission, or SEC. Without uniform standards, firms will need to make do, and cobble together a compliant economic disclosure from whatever arrangements they regard as pertinent to cryptocurrencies, from the traditional approaches set forth in GAAP. In disclosures to financiers, and, to governing bodies, businesses with cryptocurrency positions will need to be extremely transparent, and also discuss why they offer electronic properties in these financial and accounting ranges, that they do just as well as to how these financial investments figure into the overall financial investment method. It's no question that the SEC will certainly look at these disclosures closely. The Commission has made guidelines of cryptocurrency markets a leading concern. This is evident from both public declarations as well as current enforcement actions. SEC Chair Gary Gensler has commented that he would like to see more regulation of cryptocurrencies, and that the volatile nature of the investment warrants increased investor protection. The firm's enforcing mechanisms appear to be meeting their goals of educating participants on the potential for cryptocurrencies to harm investors. During the 2021 Financial Sector Regulatory Authority Seminar, Gensler recognized cryptocurrency markets as strongholds of misleading conduct by private funds, using or accounting frauds, insider trading, market manipulation, failings to act in retail consumers' best interests, reporting offenses, faulty implementations, such as fiduciary violations, as well as various other forms of transgression. Even more, As far as making complex business investment in cryptocurrencies, the SEC has actually taken various positions on the legal status of different digital properties, leading some to slam this appearance of regulatory uncertainty. In a lawsuit against Ripple Labs, the SEC has made the point that the company's electronic token, XRP, certifies as an instrument that must be registered, and that it, consequently, must also adhere to government securities legislations. The Commission has classified Bitcoin, and, also another developed electronic property, Ether, as currencies, instead of as commodities and securities. For CFOs buying cryptocurrencies, the firm's increased focus on these properties indicate that companies ought to anticipate the currently tricky landscape to transform quickly. These unforeseeable trends in supervising the landscapes, likewise pose the potential for substantial influence on the status of business holdings of digital possessions. Cryptocurrencies stand for an interesting case for CFOs that wish to save corporate funds in an asset class that supplies one-of-a-kind advantages, in addition to the opportunities that originate from making a vibrant financial investment. Regardless of these potential benefits, the cryptocurrency market is swarming with uncertainty. Countless pitfalls, in the form of lawsuits and regulatory scrutiny, indicate that companies need to be well-versed in the specifics of a digital investment, and must also prepare to react promptly to the legal repercussions. We'll now segue the podcast to specifically detail actions of several institutions, including BlackRock, Citibank, Deutsche Bank, Fidelity, Goldman Sachs, and, finally, ING, contrasting their current directions versus their nearly polar opposites from just a few years ago. 1. BlackRock, October 13, 2017. BlackRock CEO Larry Fink calls Bitcoin an index of money laundering. March 21, 2021. BlackRock fund bought Bitcoin futures in January. Regulatory filings show there's a good chance you've never come across BlackRock. Established only in 1988, in much less than 30 years, this American financial entity would certainly expand, and come to be, the company that spans the globe, managing assets worth $6.3 trillion. These are properties that come from their customers, generally the pension funds of regular people, teachers, police officers, registered nurses, as well as much more. These are simply the starting points. BlackRock has actually created a software platform, called Aladdin, to execute critical analysis for its clients. It gets sensitive data from banks, insurers, and other crucial establishments. Through Aladdin, BlackRock has insights concerning the monitoring of monetary assets worth an additional $20 trillion. BlackRock likewise has shares, as well as voting legal rights, in a number of the most prominent European companies, in industries such as energy, oil and gas, transportation, food, and, quite naturally, financing. The business holds public financial debt, in various types of bonds as well as has real estate interests. And still there's more. BlackRock, you see, puts on numerous hats. Apart from being a capitalist, it is additionally an auditor, and an advisor. Federal governments as well as central banks welcome a BlackRock subsidiary called BlackRock Solutions to examine them, and to offer advice regarding the management, and rescue of financial institutions. Yet at the same time BlackRock is commonly a significant investor in these very same financial institutions. In other words, the business usually sits on both sides of the table. BlackRock, a leading property supervisor, anticipates the global ETF market can double by 2023. An institutional investor may invest somewhere within 0.3% to 0.7%, yet much less than 1% definitely to something like a Bitcoin ETF. There are some investors who have an interest in a very early venture type of investing, so, as they think about Bitcoin as an innovation, they use their venture allocation container to place a little of money, simply 0.2% to 0.5% of their portfolio values. 0.5% does not seem significant, yet simply take the example of the 50 largest institutional investors. They hold virtually $42 trillion in possessions under monitoring. So if just 0.5% of their possessions are invested in Bitcoin ETFs, it indicates a whopping $200 billion included in the marketplace, which is much more than the entire crypto market is today. So even a fraction of that money can be a considerable game changer. However, prior to opening the flow of billions of institutional dollars, which will flood the crypto market, the SEC requires their approval for a Bitcoin ETF. The question of whether our main placement gets into cryptocurrency is a broad one, as well as the fact that there's no single answer to that. When someone intends to construct an ETF in addition to a crypto asset, we ought to create an approach in a way similar to the fact that we would approach somebody building an ETF, in addition to any other asset. However, We have not always taken the best method in accepting ETFs, for things like gold. People have yet to manage these financial elements through a regulatory authority, particularly a regulatory authority like the SEC, which does not recognize how long decision processes of this type can actually take. As well as this all holds true, the process for getting a Bitcoin ETF on the market began all the way back in 2013, when the Winklevoss twins initially made the proposition. 2. Citibank, May 2014. Citibank says that over 10% of all Bitcoins have been stolen or seized. March 2021. Citibank says that the biggest change with Bitcoin is the shift from it being primarily a retail-focused endeavor to something that looks attractive for institutional investors. In a search for yield in alternative assets, investors are drawn to Bitcoin's inflation hedging properties, and it is recognized as a source of digital gold due to its finite supply. The first Citi GPS venture right into digital money was back in 2014, once they featured it during a write-up, in their second Disruptive Developments report. Once they reviewed Bitcoin, they did so with the caveat that it had been a high-quality electronic currency, also as an easily available generic Bitcoin innovation. However, there was the capacity that a non-Bitcoin different digital currency would at some point supplant it. In May of 2014, once they released the record, Bitcoin was simply 5 years old with a market value around $6.2 billion. They wrote that with reference to Bitcoin, they welcomed younger generations, and anyone else listening. It had been recognized that older financiers, who may have listened to the word, were typically less intimated, and were also generally less convinced. They identified that there was little or no Bitcoin activity among institutional investors in organized financial markets, because it was considered much also dangerous, also as unpredictable. Ultimately, they still evaluated Bitcoin as a would-be property, and an aspirant suggesting of a deal, and regretted that although you'll acquire an excellent deal of Bitcoin, however, there wasn't much to try to do with it. Another thing they've acknowledged while writing Citi GPS reports on disruptive advancements, is that the time it takes a replacement product to return to be extensively employed, by worldwide consumers, has reduced considerably. Consistent with Visual Capitalist, it took the phone half a century to succeed in 50 million consumers, 22 years for television, 7 years for the online and also simply 19 days for Pokémon Go. So it isn't a shock that the uptake of Bitcoin within the previous virtually 7 years, at that time, was actually just phenomenal. Not just has Bitcoin raised in usage and price, striking $1 trillion in market capitalization through September 2021, however it's developed a whole ecological community around it including crypto exchanges, crypto financial institutions, also as new offerings right into financial savings, borrowing, also as loaning. In a connected report, the writers kept in mind the foremost significant change with Bitcoin is the shift from it being largely a retail-focused endeavor, to something that appears attractive for institutional investors. During a look for yield also as through different possessions, capitalists are drawn to Bitcoin's inflation hedging aspects, while it's also acknowledged as a resource of digital gold thanks to its limited supply. Certain enhancements to exchanges, trading, data, and guardianship solutions are increasing and also being overhauled to accommodate the wants of institutional capitalists. 3. Deutsche Bank, January 27, 2020. Deutsche Bank says Bitcoin is too volatile to be a reliable store of value. The value of Bitcoin is entirely based on wishful thinking. March 18, 2021. Deutsche Bank says that Bitcoin is now too important to ignore. Deutsche Bank has signed up with the growing ranks of huge financial institutions finding out cryptocurrency protection, with goals to supply high-touch solutions to hedge funds that purchase the possession course. The Deutsche Bank digital property guardianship model aims to make a fully integrated custodianship system for institutional customers, and also their electronic properties, giving seamless connectivity to the broader cryptocurrency ecosystem, consistent with a little-noticed record by the World Economic Forum, host of the annual celebration of head honchos in Davos. Buried in a December 2020 record, Germany's largest financial firm claims it intends to supply a trading and also token issuance platform, linking electronic possessions with conventional financial solutions, and also managing the choice of electronic assets and also fiat holdings in one easy-to-use system. Huge financial institutions are currently introducing strategies to travel into crypto protection on a practically day-to-day basis, with Bank of latest York Mellon, the world's biggest custodian financial organization, joining a recent event. U.S. financial institutions were offered some regulatory clearness many because of in 2014's interpretation letters from the workplace of the comptroller of the currency. In Germany, companies are marking time to get their hands on unique crypto wardship licenses from the country's regulatory agency, BaFin. Deutsche stated it's finished its version of a symbol of concept, also as is aiming for a minimum sensible product in 2021, while exploring global customer passion for pilot initiative. 4. Fidelity, why is a $7 trillion investment firm bullish on Bitcoin? One of the major standards for Bitcoin developing itself as a store of value will be driven by the merging on the narrative that it's a store of value. It has more than $7 trillion in assets under management, also consisting of cryptocurrencies. So why has Fidelity devoted a subsidiary specifically to the study and also safekeeping of Bitcoin? The upside is indistinct, but they're also past the factor where there's an equal or greater likelihood that it is likely to absolutely dive, as Fidelity analysts break down their Bitcoin financial investment theses on how Bitcoin can come to be a well-established store of value. Fidelity's Riabutoria claims that purchasing Bitcoin today is a parallel to investing in Facebook, when it had 50 million users, with the perspective to expand to the more than 2 billion customers it has today. The objective of this example was to set the structure for where she thinks, and also numerous others also believe, Bitcoin is today. Individuals typically contrast Bitcoin to a beginning startup, which indicates that it has a respectable chance of failing or returning to absolutely zero. This Facebook analogy indicates that, like Facebook, at 50 million users, the benefit has some uncertainty. But, they have actually gone very far past the factor where there's a reasonable chance that it returns to zero. 5. Goldman Sachs, May 28, 2020. Goldman Sachs lists 5 reasons why Bitcoin is not an asset class, nor a suitable investment. March 1, 2021, exclusive, Goldman Sachs restarts cryptocurrency desk amid Bitcoin boom. Wall Street behemoth Goldman Sachs has anticipated Ethereum has the potential to eclipse Bitcoin in the coming years, and also advised the severe crypto price volatility indicates it can't compete directly as a safe haven property, like gold. This dominant Wall Street firm has actually anticipated Ethereum has the possibility to overshadow Bitcoin in the coming years and also advised the severe crypto rate volatility means it can't compete directly as a safe haven asset, like gold. An ex-Goldman hedge fund director anticipates Bitcoin will reach $250,000 to $400,000, and also, Ethereum will certainly surpass $20,000 by next March. He lays out his financial investment instance for the 2 largest cryptos and shares other altcoins in his profile. Goldman Sachs thinks Ethereum could surpass Bitcoin. Here's why. The surge in Bitcoin as well as cryptocurrency prices has catapulted electronic assets right into orbit this year, with the crypto market's performance requiring Wall Street's interest. Goldman has actually forecasted the Ethereum price can remain to outmatch the Bitcoin price, possibly surpassing Bitcoin as the dominant crypto store of worth. Bitcoin, at a rate per coin of $48,000, currently has a market capitalization of around $900 billion, while Ethereum, at $3,500 per Ether token, deserves an equivalent of $400 billion. Amidst the recent volatility in cryptocurrencies, we ask experts whether cryptos can, and also need to be taken into consideration an institutional property class, including Galaxy's Michael Novogratz, NYU's Nouriel Roubini, Grayscale's Michael Sonnenschein, as well as Goldman's very own Matthew McDermott. And Goldman's study experts likewise chime in. We then speak to previous SEC expert Alan Cohen, Path of Bit Stan Guido, and chain analysis Michael Groninger to discover the governing, technical, and also protection obstacles to additional institutional adoption. Bitcoin's rally, in excess of 300% over the last year, has actually been towered over by Ethereum, the second largest cryptocurrency after Bitcoin by worth. The Ethereum price has included some 800% since this time in 2014. Now, as those in the cryptocurrency sector attempt to forecast the market's direction, experts at Wall Street giant Goldman Sachs have actually anticipated Ethereum has the possible to eclipse Bitcoin in the coming years, and warned the severe crypto rate volatility indicates it can't compete directly as a safe haven property, like gold. Goldman Sachs has predicted the Ethereum price might continue to outshine the Bitcoin cost, potentially surpassing Bitcoin as the dominant crypto store of value. The Ethereum token currently resembles the cryptocurrency with the highest real usage capacity as Ethereum, the platform on which it is the native digital money, is one of the most prominent growth platform for smart contract applications, Goldman Sachs scientists wrote in a note to customers, initially reported by Business Insider. Ethereum has actually seen a flurry of activity on its network over the last 1 year, due to the soaring popularity of so-called decentralized financing, DeFi, and non-fungible tokens, NFTs, both exclusively built on Ethereum's blockchain. This year, DeFi, the idea that standard economic products can be recreated using crypto technology in place of the bank, has actually expanded to a multi-billion-dollar market, while NFTs, tokenizing various digital assets and media on the blockchain, have actually recorded the attention of artists, developers and also sports celebrities. Goldman Sachs is one of many in a line of investors to also select Ethereum as a better than even bet than Bitcoin. Last month, the primary financial investment policeman at $100 million electronic property financial investment manager 2Prime, predicted Ethereum will ultimately flip Bitcoin to become the largest cryptocurrency by value. Bitcoin, at a price per coin of $48,000, currently has a market capitalization of around $900 billion, while Ethereum, at $3,200 per Ether token, is worth a consolidated $380 billion. 6. ING, December 18, 2017, Why Bitcoin is Destined to Become a Niche Asset. December 9, 2020, closer to a crypto custody offering, Dutch-based ING spoke publicly for the first time about its initial trials with digital assets. Talking at the Singapore FinTech event, ING blockchain leader Francois talked about the job done so far with Picter, a custody, and also post-trade infrastructure for crypto possessions, that was consisted of in this year's accompaniment to the Financial Conduct Authority's regulatory sandbox in the UK. Picter, a collective effort, including ING, ABN AMRO, BNP Paribas Stock Solutions, Citibank, Invesco, Societe Generale, State Street, UBS and others, is developed to make banks feel comfortable taking care of crypto. The task involves layers of safety and security such as multi-party computation, MPC, and hardware safety and security module, HSM, modern technology, as well as is additionally decentralized, according to Francois. ING is creating modern technology so that its clients can safely save electronic properties like cryptocurrencies, Reuters reports from those familiar with the matter. The company also revealed that it sees increasing opportunities involving electronic possessions, both asset-backed as well as indigenous security tokens. ING noted a focus on providing a compliant method to access the market. Reuters sources stated that the protection job is running out of its Amsterdam offices, however that it's still in its onset. The financial institution supposedly additionally has numerous other blockchain campaigns. Keeping cryptocurrency safe has actually ended up being a service by itself. In 2014, famous cryptocurrency exchange Coinbase began supplying its own protection services. While Coinbase is certainly a relied-on exchange, for a family name like ING to provide similar solutions would just be a benefit for the digital possession market. While most of us currently recognize something regarding cryptocurrencies, most of the information is still a little sketchy. We aren't clamoring to recognize the details of how cryptocurrencies function, or even what they are. Whether we would certainly be extra inclined to accept digital currencies, if verified as relevant, and, as useful to our everyday monetary lives, is still open for conversation. We understand that more expertise regarding the operations of crypto doesn't necessarily cause favorable expectations of exactly how they will be utilized in the future. Undoubtedly, it was the teams with a reduced degree of understanding who often tended to be more available to future adoption. This highlights that the crypto-curious aren't necessarily persuaded of the benefits right now. These findings follow just how individuals say they discover cryptocurrencies. Some appear to build their expertise of cryptocurrencies passively, that is through information, at 33%, and social networks, at 13%. There are clear distinctions in the strategy throughout countries nonetheless, suggesting that for some, rate of interest might be affected by the local context. Total adoption will just take place if these currencies prove themselves to be pertinent to daily financial lives, trustworthy as well as helpful. It's not what we recognize regarding cryptocurrencies, but just how beneficial they are, that will certainly drive inclusion. Some people are already rather favorable concerning the future use of cryptocurrencies. We see this in positive responses to concerns such as, are cryptocurrencies the future of spending online? Would somebody that acquired cryptocurrency a year ago feel comfortable about their decision now? Will the worth of cryptocurrencies increase in the next year? As was much anticipated, these people compose a minority of the populace in all but among the 15 countries we evaluated. So, while there's still minimal levels of presence, it does exist in all nations. And it shares similar attributes. These individuals are normally available to, and trusting of, new modern technologies. For instance, they are more likely to take into consideration different recommendations with regard to managing their liquid assets. Technologies that have been in existence longer, and also are more acquainted, are more likely to be ranked as safe and secure by consumers. Just over a quarter, at 27%, additionally claim that they are open to having new financial items that use cryptocurrencies and that are provided by recognizable financial providers such as their main financial institution. Trust and faith in the familiar is a consistent goal within ING surveys, as well as recommending that incorporating the processes, as well as carriers, that are already accustomed to with new currency, might be most palatable for consumers, as contrasted to a radical shift. Some type of electronic money or cryptocurrency hybrid may therefore be what normally creates future opportunities. Crypto won't always replace more well-known repayment approaches. Money appears to maintain high, everyday appeal. Therefore, if we are to relocate toward the use of digital currencies, and, also cryptocurrencies, diversity of the different repayment, as well as financial investment suppliers in use, is most likely to occur in the short term. This might suggest that while an increased selection of choices is available, they choose what pertains to the sort of purchases being made, and, also to individual choices. As people are provided a lot more options, this could cause accessibility improvements within the economic environment. In our next podcast, we'll examine the insights, and, reactions to recent hints from Federal Reserve Chairman Hank Powell, who continues to drop hints of removing some of the addictive quantitative easing to infinity, from the markets of the past 12 years. This is bound to have long-lasting impacts on the psyches of the equity bulls, and, thereby the dips autopiloting. So be sure to catch us next time. If you enjoyed the podcast, don't forget to smash the like button, and, subscribe to our channel. Until next time, let's stay busy.